And hello, welcome to another episode of the Coolest podcast, the podcast of Coolest.Marketing, where I interview different instructors from the platforms. And today I have the pleasure to have Tomer Hoffman. How are you, Tomer?
I'm okay, thank you.
So we're going to have a very exciting and different talk today, more about the financial aspects of ventures. And before we dive in, please, Tomer, present yourself before we dive in.
Okay. So basically, I'm almost 30 years in the financial management arena. I was a CPA, an accountant. Most of my career, I was a CFO. More than 10 years ago, I went on my own way, established my own firm, first with a partner, then alone. I help entrepreneurs and companies, startups and others walk their own path, succeed in what their goals are. We utilize financial tools, financial methodologies that used to be used in big companies, in corporates, where I come from. And we apply them into the small companies in order for the entrepreneurs to have more control, to have a better look, to have a higher and a deeper look, both simultaneously on the company, on the path, on the goals, and on the way to succeed in achieving them.
Super cool. So I'll be honest with you. This talk is not about my favorite topics in entrepreneurship or marketing. And
surprise, surprise.
And that is why I find it so important to have this conversation and to have you as instructor in Coolest.Marketing and your course, which we'll discuss later on. And because of that, and because I see in the last few years more and more demand for marketing personas to present to investors, and it could be creating the pitch itself, and it could be actually finding the investors, presenting the pitch, and etc. And of course, it's related even to the entrepreneurs, the CEO, the CFO, whoever is talking with the investor. And what I find really interesting is one of our conversations where I, again, complained how much I hate talking about financials and projections about the next year and stuff like that. It's always feels to me, to look into the future or talk about stuff that can't be really understood to nobody. And then you said something interesting. You said that I should look at the financial part of a pitch as an opportunity and not as a headache that is just waiting to blow up everything. And you even said that nobody is expecting me to know the future. So can you please elaborate about how come this annoying part of the pitch is actually an opportunity?
First of all, let's talk about the statistics, about the numbers. The investors, the VCs, they see hundreds or thousands of applies in a year. Each of them probably gets lots of emails, see lots of decks, gets into tens or hundreds of meetings in a year. And he actually looking for the reason to say, no, thank you, not now.
It's looking for the reason.
We're looking for it. Why? In order to get into the better part of the pile, right? Like in a funnel. So, like when you screen resumes, you're looking for the quickest ways, words to screen the unrelevant data. So when you come prepared, you kind of surprise him in relation to the other part, to the other entrepreneurs. And when you speak your vision, speak your passion in a way that present both the product, the technology, and the financials, the legal part, which normally you leave it aside, you kind of separate yourself from the pack. So it's an opportunity, yeah.
Okay.
A differentiator, maybe.
So one thing is that other people like me hate it, so they come not prepared.
Mm-hmm.
What about how exactly prepared the investors actually expect us to be? Like, okay, I can imagine the first year, but then the projection is about year 2 and year 3, and what about how the market evolves and stuff like that? Do they really expect me to see the future?
So the quickest way to say it is no, but they want to see, they mostly look at the way you think, at the way you prepare yourself, at the way you think of the various opportunities that the market can evolve into. Obviously, all of them are guesses, right? So probably none of them will come into maturity, into reality. But they want to see how do you react, how do you prepare, how do you even engage with them in hard questions when they ask you. They want to see how flexible are you in your mind, in your thinking, in your way of looking into the problems. It's all about being a problem solver, right? Mm-hmm. When you're a founder, you get tens of problems every day in your desk. So although they don't expect you to see into the future, they expect you to project into a certain reality among one of the tens that possible.
So in a sense, you're saying it's not that they expect me to know the future, they are testing me of another way how I think about things, how I prepare, or how I see the market. So you've mentioned hard questions, how I answer hard questions. Do you have an example or two for hard questions that most entrepreneurs, try to ignore or to move on as fast as possible?
First of all, there are numerous questions. I mean, there are thousands probably. The first time I encountered myself, and I felt like an idiot sitting in front of an investor asking me these questions. It was about the legal financial aspects of the previous investors in the company, and we were prepared for that. And it wasn't that hard. I mean, we should have known it will become an issue, because in that fundraising, it was critical. But we weren't prepared. We were talking about the product, the technology, the opportunity for the investors, but there was an elephant in the room that we ignored. So that's a good example, because it's not so common. The more common is what would you do if your burn rate will go higher? It seems an easy question, but then the entrepreneur says, like, he freezes. He kind of he's stuck. He memorized the spreadsheet, the Excel spreadsheet, and now he's asking him to move aside. And every time the investor asks you something about something else, about what if questions, it's a question you should be prepared for. And the easiest way to do to be prepared is to do simulation, to first figure out ahead what could be the hard questions, and then from one meeting to another, just to be better, to get better, to figure out what was the worst or the bad question that I couldn't answer good, or in a good manner, and prepare better for the next time. I mean, it's an evolving process.
So it's interesting you say it, because it's so obvious to do all you said, to the simulation, and each time writing down what went wrong and what went good. But we always do it on the creative side, on the products, and there's usually no real energy putting on the financial part. And I remember when we start talking about your course, we talked about your need to help entrepreneurs never again that they'll find themselves idiots in the room.
Exactly.
Once the financial part of the pitch is arriving, and even to make it as an opportunity. So there's something interesting in your course, which I invite everyone to go to the platform Coolest.Marketing and check it out. And you talk about the financial narrative, and I find it's really interesting. Can you elaborate about that?
So the financial narrative is kind of a lineup, right? So the investor wants to know where you came from. He wants to know the past. He wants to know the present, and he wants to know where you're going, the future. So that's the narrative. It's like a movie. Although we're not expecting any twist or unknown twist in the plot. So where you came from, he wants to know the usual. I mean, the usual suspect. How much you raised so far? What are you doing? What's the technology? I mean, how much you achieved so far? Have you got any validation from customers, traction with customers? Have you talked to potential customers, if no real contract or sales? What are your achievements so far? I mean, what's your team? And then if you're talking about the present, what's your burn rate? What's your key personnel? Where did they came from? Talk about what are you going to achieve in the future? That's the future part. What's the milestones? You want to know how to reduce the risk. I mean, what's the risks? Market risk, technology risk, competitor arena. Competitor could be not just direct competitors, but other solutions to the problem that you're trying to solve, right? So that's basically the narrative. The narrative is speaking all the time, even about the financials, as a story, like in a way doing it, making the pitch or making the meeting to be as a one big storytelling event. Now, I know it's hard, but I know we in the presentation we always try to make it as a good story. But there are different parts of the presentation which we should focus as well as a small story. Within the bigger one. So so we talked about the past, present, and future. We're talking about elaborating the key financial factors, the metrics, the KPIs, the parameters that will enable us to view if you are in the right path. It could be just financial figures. It could be KPIs. We should show how we use the KPIs in order to reduce the risk or to know if we are in the right path or in the wrong path. So everything should be in a story, or in a way, if you're asked, okay, how much you're raising, and you're saying figure, let's say, I don't know, $2 million, and the investor says, okay, why, or based on what valuation, you're not supposed to answer, or at least to my opinion, you're not supposed to answer about the valuation. You're supposed to go back into the story, meaning, okay, I'm trying to raise $2 million because I'm planning this and that. Obviously, elaborate on the headcount, about the technology, about the other stuff that you need for a certain period of time. and I'm going to achieve this and that, and these are the milestones that I'm going to achieve, and this is how we're going to see if we achieved them on time or not on time, and I'm going to come back to you in, I don't know, 20 months from now or 24 months from now, and I'm going to ask another amount because we achieved the milestone and we need more money. And about the valuation, it's because I'm willing to share this certain amount of shares of the company with you, for example. So everything should be a story. And if, for instance, you see that the market is kind of stretched, and the investors are not willing to give, $2 million in this particular time, and you want to raise less. But how would you do that? The story now is changing. You're now probably raising $1 million, but you're raising it for 18 months or 10 months only, or you're reducing the hiring, the headcount, or you squeezing the scope of work, the scope of development that you're gonna do, or the broad way that you look at the solution of the product, of the development. So the story has to match the financials that you're seeking, the financials that you're presenting.
All right. We had long conversations about investors and the industry, and we're here in the startup nation, in which there's like an inner ecosystem of startups out there, and a lot of startup founders find themselves, running from one investor's talk to another, working mostly for that investment. And a lot of times they hear, that's very interesting. Come back to me in 2 months and we'll go over. And then 2 months later, they're in the same point, especially, pointing out for a financial, but not only. So as a CFO, as a service that we've been through so many investments and fundraising, do you have any tips to that specific loop, that trap that so many entrepreneurs find themselves?
Yeah. I'm talking quite significantly in my course about that. Almost 2 full modules. One, there's how you manage the fundraising event attraction. It's like a sales funnel, and we'll talk about it in a second. The second is your mindset during that, which is as important as the first one. So about the first section. As I mentioned before, the investor will always look for a reason to say no. So you need to avoid that. But what happened in the case that, or in most cases that you get the no? First of all, there are lots of ways of saying no, of getting a no. So you mentioned several of them, the American polite way of saying no. Not now, no thank you, maybe later, let's schedule a meeting 2 months from now, let's have a lunch, right? They are all no. There's one more promising no, says, if you get a leader, I'll be happy to join, which means you didn't convince me, but if someone bigger, richer, smarter, more popular than me says yes, maybe I'll join because I don't want to miss out. And if we're going back to if we're talking about the missing out, you always have to manage the FOMO, the fear of missing out of the investors. And you have to help them to help you. Even they have their own investors or their own committee or board they have to report to. So if you're saying, yeah, I'm kind of in a round now, and I'm meeting some people, and I'm moving, so they're feeling very comfortable to say, okay, let's talk about in a month. Because in a month, the risk will be reduced because something has happened or should have happened in a month from now. They always have not the willingness, the want, the need to delay, to postpone it. And you have obviously the opposite way. So you have to manage it in a way, like in a sales funnel, you have to approach many investors. You have to direct or to refine the type of investors you are addressing. You have to make to make it like a campaign, and you have to make them all work in same speed. I mean, you can't have one investor very quick and saying, okay, I'll draft you a proposal, I'll send you a term sheet, and the others like saying, okay, let's meet in another month. No, because now there's no FOMO. There's only one in the race. The others don't know that they should be more quicker. So you have to manage it. You have to delay the more quicker investors, and you have to hurry up to herd the more busy or lay back investors.
So do you have like a rule after the third let's talk in 2 months respond? Should I say that's enough, or because it's really hard to be an entrepreneur and not see this as an opening to another, probably in our fourth meeting is gonna convince. So do you have any tip for that?
First of all, you have to be ready to hear no, lots of no's in different ways. That's about the mindset. You have to learn to improve from each meeting to another. You have to ask the investors in front of you, if you hear the no, even if it's the polite no, ask them for a feedback. What do you think I should improve? Okay, I understand yet you're not going to invest in me. What do you think I should improve for the next time, for the next investor? What did I do wrong? Most of the investors will be willing to give you the information. Most of them. More likely, it will more likely happen if you're accepting the criticism. It's not easy. It's not easy to get a no, and then have a big smile and say, okay, can you please help me in my next phase and give me tips how to improve my presentation, my deck, my speech, my narrative, my whatever. It's not easy, and you kind of kind of test it for that as well. And moreover, it could be that you're not the exact match for the fund, for the VC at that time, or at that vertical of technology, or you kind of, maybe you have a competitor in the fund, and they don't want to have another one. They may refer you into their own colleagues. Mm-hmm. They're doing a how do you say it? Competition and cooperation, mm-hmm. Whatever. Mm-hmm. They're working together. They're talking to each other, and they may refer you. They refer you if they see that there's there's a possibility that the colleague that they get you from them,
that they would look good.
Yeah.
Okay. Yeah. Okay. Okay. So, in a nutshell, not what can we expect from your course? What the user, the student can expect to know and to change the day after he takes your course. And of course, you can check out all the lessons and the modules themselves in the page of that course, but give us, a wide perspective of what can we expect from.
First of all, the topic says it all. I mean, you would learn how not to become an idiot in front of investors, right? That was my first experience, and I don't want you to feel that as well. You learn how to say, how to speak the financial narratives. You learn how to understand what the investor wants and what they don't want, what their fears and what they're looking for. You understand how to measure your financials in a way that you can tell them as a story. You understand how to manage the process. You understand how to become a better founder or better fundraiser. If you train your mindset, if you know that the process is not like a one shot. So it's about improving your opportunity to succeed in the fundraise.
All right. So I can expect knowing the different, the 3 letters in English, CP, whatever, and all of that, from like the most fundamentals to the mindset.
We'll talk about the financial, we'll talk about metrics, we'll talk about the 3-letter words that we use, but we'll talk about them in general. We'll mention many of them, but not all of them, and we're not gonna dig deep into each of them, because they're all different. I mean, they're all related to certain companies, and not it's not a one size fits all. And you're not going to be an accountant. You're not going to be a CFO. You're not going to be.
Thanks God.
I know. But you're going to talk the language. You're going to understand what they requested. Mm-hmm. It's going to be easier for you to work with the CFO, to work with the financial people, to understand what they're saying, and to make it more productive.
Super cool. And as I've mentioned before, on Coolest.Marketing, you can have a bundle of buying the course plus an advisory chat with the instructor in a low cost. So check it out. Tomer, thank you very much.
Thank you. Thank you, Elad.
Bye-bye.